Roth IRA conversions. Should you do a Roth conversion? Isn't it better to leave the money in the pre-tax account? Why pay taxes now when you could pay taxes later? This is what's on my mind today. Hey, I'm Kaleb Paddock, the founder of What's on My Mind. By the way, check out the new digs. While everybody's working at home, I went out and got an actual office space. It's the Kansas City Shuffle. Everybody goes one way, I go the other way. Just what we're doing right now. So Roth IRA conversions are what's on my mind today. I've been speaking to a lot of clients about these, and I heard a little misconception that I wanted to break down here. The idea was, if I can get better growth in my IRA or 401k, that is better than doing the Roth IRA. Or, if the growth here, and I said, whoa, slow down. The only decision we need to be talking about is what's called terminal tax rate. Meaning if your terminal tax rate, when you go to pull the money out of your IRA or Roth IRA, that is the key factor here. So this is what I mean. If you're paying a combined tax rate of 45%, you're in the highest bracket, individual tax bracket in America right now, you may want to get a pre-tax deduction so that you avoid 45% tax, federal and state. Avoid that now. Pay tax later at your terminal rate, which would potentially, hopefully, fingers crossed, be lower than that 45. Even if tax rates go up, the idea would be that your lifestyle burn rate is lower than the income you're making right now. I mean, you'd have to be making over $500,000 a year for that terminal tax rate to likely be higher in the future. Versus doing Roth conversions, Roth contributions now, you're basically saying that your terminal tax rate in the future will be higher. So maybe right now you're paying 15, 20, 25% marginal. There's marginal, that's another video, but you're paying about, let's say, 20% now, and it's likely that either based on your burn rate and or tax rates themselves going up, you will be in a higher tax bracket later. So this idea of terminal tax rate versus current is the only factor. If you hold all other variables constant, then if the balances are the same, if the contributions are same, like 8% growth in one account versus 8% growth in another, like if all variables are held constant, we are only discussing a terminal versus current tax rate decision. That is it. I've done the spreadsheets for you. I've run the numbers. That is all that matters. Now you can hack this, meaning in a Roth account versus IRA, you can do $6,000 a year or $7,000 if you're age 50 or older. But here that's called catch up. So let's just say you do 6,000 IRA versus 6,000 Roth. You actually are putting in more money in the Roth because 6,000 Roth is really more like 8,000 of actual gross income to you because of taxes. You have to make 8,000 to put 6,000 in the Roth because you pay tax now. Versus in the IRA, you only need 6,000 of gross income. You stick it in, you get the pre-tax deduction. But remember, that 6,000 is not all your money. It's a joint venture. You're going into a partnership with the IRS. That money's going to grow, but a portion of it is the IRS's money, and a portion of it is your money. It's tax deferred, but a portion is yours, a portion is the government's. In the Roth IRA, it's all yours. So again, keep this in mind. I've thrown a lot in this video, but let's just go back to the beginning, which is don't confuse yourself. Don't make this more confusing than it is. We're talking terminal tax rate versus current. That is it. Thank you for watching this episode of What's on My Mind. I love it when you guys are watching these videos. Comment, like the post, or if you're watching this on YouTube, smash that like button, subscribe to my channel, and you can get more videos like this, What's on My Mind in the moment. Thanks so much. Bye now.